Good morning to one and all. So now we are here to present our paper, a portfolio analysis with fund creation using top 30 stocks of Bombay Stock Exchange. This is a case study of William Sharpe's single index model. We are from ABBS School of Management and my name is Dr. Naresh. Since the paper is about the diversification portfolio, we start the concept with the investment. So usually people invest their amount for getting higher returns or profits, and no one will be willing to have the loss. So maximum people will expect higher returns with minimum risk. But the unfortunate thing is that higher returns will be usually able to get with the help of higher risks. But no one wants risk. So what we have to do with that? So in that case, we cannot reduce risk completely, but it can be managed or mitigated when we have a perfect plan. Okay, this can be done with the help of diversification of or asset allocation in different segments through proper research and analysis. Usually investors have got lot of investment of avenues for their investment purpose. Maybe they can go for banks for investment, or they can go for post office, provident funds, insurance products, real estates, real assets, equity, mutual funds, and other antics. But most of the people who wants quick returns will opt for stock markets, because stock market is a place where the investors can get quick returns within a short span. And excess return in the stock markets are logically related to total risk of investment. Okay. Many of the researchers found that higher will be the risk, but at the same time, the return also will be higher in stock market. Even in that case, we can do some diversification to reduce the risk and to get somewhat higher return when compared to other people. There are a lot of studies happen on diversification, which started with Harry Markowitz, and he has developed a model in 1952 with the help of mean and variance of different stocks. Based on that, in 1974, Modigliani and Pogo has done some research, and even they found that investors prefer higher returns with a lower risk. An extension to that has been done by Blitz and Vlad in 2007. Even in their research, the volatility effect, lower risk without lower return, they found the relationship between historical volatility and risk-adjusted returns in the stock market. There are some more researches happened in that line, like in 2006, Eugen and Frederick has done a research on Sharpe and Trainer ratios on treasury bills. This deals with the relationship between treasury bonds and different ratios, which gives some additional return to the investors. In the paper presenting a comparative model of stock investment portfolio optimization based on Markowitz model by different people by taking 25 listed companies on Tehran Stock Exchange, they found maximum people are willing to get higher returns with less risk. So as we have already told, our project is going to be building a portfolio with the help of top 30 stocks in Bombay Stock Exchange to reduce the risk. So that is going to be a need for our study. And the scope of the study, the data has been collected from Bombay Stock Exchange official website for a period of 2 years, from January 1st, 2019 to January 1, 2021. And the analytical work is carried out with the top 30 stocks, and we have calculated expected return, variance, risk, beta of that particular stock, Trainer ratio. Based on that, the portfolio has been constructed. And the limitations of the study, we have considered only top 30 stocks, and there are some thousands of stocks in Bombay Stock Exchange, which can be used for the construction of portfolio. But for time limited, with the limited time, we have conducted only with top 30 stocks portfolio creation. So now you can see the top 30 stocks like starts from Asian Paints 1, Axis Bank 2, Bajaj Finance 3, like that. And that the top 30 stocks in Bombay Stock Exchange are listed here. And we have calculated average returns for that 2 years. Average returns are like this, you can see on the screen. Next, we have calculated the variance of each stock. Okay, so variance of each stock also has been mentioned in the screen. The next, we can see the standard deviation and systematic of risk of each stock has been mentioned on the screen. Next thing is the beta of particular stock. So this is systematic risk. Okay, how that particular stock is moving with Sensex, whether positive, negative, something, and we have mentioned that. Next is the trainer ratio calculation. Okay, so trainer ratio is return from that stock minus risk-free rate of return. The total component is divided with beta of that stock. Okay, so this is reward to risk ratio, like how much additional return that they are getting as they are parking their funds in some riskier assets. Okay, for our convenience, we have assumed risk-free rate of return as 4% for this period. The next is based on this trainers ratio, we have given ranks. You can see the first company, Asian Paints, has got rank as 7 because the trainer ratio is 0.46. And which company has got first rank is Infosys. So for Infosys, the trainer ratio is 17.05. So which is the highest trainer, which has got highest trainer ratio. So we have given the first rank. Coming to the second rank, it has been given to TCS because the next trainers ratio is 2.916. The third rank has been given to Titan because the next trainer ratio is 1.1. So it has got rank 3. And the next rank has been given to Wipro because the next ratio is 0.583. Like that, we have calculated trainers ratio and we have given rank with the total 30 stocks. Okay. So out of these 30 stocks, we are not going to take all the stocks to our portfolio. There is a cutoff rate defined with the help of this formula, which is on the screen, which tells about which stocks should be included and which stocks should be excluded. Out of 30, we are not going to take all the 30. Which stock has got more turnover ratio than cutoff rate, cumulative cutoff rate, only those stocks will be included in portfolio. Okay, so the formula seems to be somewhat bigger, but it is just variance of market and the additional return the stock is giving when compared to risk-free rate of return, which is multiplied by beta, and it should be divided with the variance of that particular stock. And this is what the same thing related to the systematic risk. So because this gives the overall cutoff rate, and we are going to include only stocks whose trainer ratio is more than the cutoff rate. You see, the first company, trainer ratio is 17.05, the cutoff rate is 0.004. As trainer ratio is greater than cutoff rate, we have included this in portfolio. The second company, TCS, cutoff rate is 0.016 and trainer ratio is 2.916. As trainer ratio is more than this cutoff rate, we have included that also in our portfolio. So the third company is Titan, whose trainer ratio is 1.11 and cutoff rate is 0.046. So we have included that. Like that, out of 30 stocks, we were able to include only 7 stocks because only these stocks have got more tenor ratio than the cutoff rate. If you see from in the table from 8, so these are the stocks which have been mentioned in some other color, like orange color. The tenor ratio is 0.043 and the cutoff rate. As cutoff rate is more than this thing, we have not included this in portfolio. Like that, if you consider these are the companies which have been got false, these have got rejected in portfolio because the tenor ratio is less than cutoff rate. Okay. Now we out of 30 stocks, we are going to include only 7 stocks. The next concept is how much should be included, how much portion should be invested in Infosys, TCS, Titan, Wipro, something. And this is an elbow diagram, which also tells about the same thing, like if you see this cutoff ratio is increasing in a blue color, so we are going to include only 7 stocks in our portfolio. Okay. So this proportion of investment will be decided with the help of Z score. Okay, Z score, and this is the formula which has to be used for Z score. This tells like how much portion or proportion should be invested in that 7 stocks individually. So when we use this formula, Infosys has got 3.51, TCS has got 2.41, Titan has got 1.41, something like that. And the total Z is 10.08. And based on that, we have to include the proportion of investment. Okay. If you just calculate that, Infosys, we have to invest 34.86 in Infosys, 23 odd percent should be invested in TCS, 14% odd should be invested in Titan, 11% odd in Wipro, 4.87 in Dr. Reddy's, around 6.6 something in HCL, Asian Paints 4.43. Okay. And this is what the proportion of investment of our portfolio. We have created a fund which whose investment proportion will be like this. Okay. Based on that, as we have calculated in 2019 to 21, so these are the returns given by 7 stocks, and these are the unsystematic risks. Okay. If you find out the total risk and return of that portfolio in that 2019 to 21, our portfolio has given 34.5% return, whereas market has given only 18.61%. And risk is definitely higher, because that is what we are trying to find out. Like higher the risk, higher will be the return. Like how much is return and risk. So that is what now we are going to quantify. And the market risk is 21. So for 21% risk, market is giving 18% return, but the portfolio which we have created with 7 stocks has given 34.5% return with 30.4 risk. The same study has been extended to 2022. And in this, you can see only Titan has given a negative return and rest of the companies have given a positive returns. Okay. In 2022, risk of market is 18.6% and return from market is minus 0.017. Whereas portfolio's risk is 20.4, the return is 17.66. Now you can see that the portfolio which we have created has outperformed the market. So that is going to be the conclusion. So in either 2019 to 21, based on that data, we have created a portfolio even in 2022. In that case also, the market risk is less, return is very, very less. In fact, it has become negative, but portfolio has given positive return and very high return. So this is, and so thank you for giving us the opportunity to share our views on portfolio creation. Thank you.